Today started with a note of optimism with a stock like Disney leading the way in the pre-market session. We even heard news that they're going to plan to reinstate the dividend later in the year. And then once the stock market opened, all heck broke loose to the downside, largely led lower by Alphabet/Google for the second straight day. That stock was nosediving and put a lot of pressure on the market. So today was a tough one across the board. No single sector actually closed in the green here today. Of course, there's a lot of other things going on, including, the gold market is really starting to spill over. We're going to talk about that in tonight's video. We're also going to talk about the utilities. They've gotten hit so hard recently, they now have an oversold cluster signal. And speaking of oversold cluster signals, in tonight's application example, I'm going to show you a healthcare stock that has recently been giving us not only weekly cluster signals, but monthly oversold cluster signals, and it got demolished in price today. I'm going to try to step into that by doing what's known as selling a put. And that way, if it does fall another 10% from here, I'm putting myself on the line for purchasing shares for this class account. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 9th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. And we'll also give you the heads up on which stocks are giving you overbought and oversold cluster signals at the bottom of those emails. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZ. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, scored this one for the bears, right? We've had a lot of bullish days so far in 2023, but it feels like a little bit of a temperature change here in the last couple of days. Today felt a little bit more chaotic than what we had been used to. It felt a little bit more 2022-ish. Now, it wasn't a disaster in the end. The market was actually down less than 1% when it was all said and done. But there were some more exaggerated movers here in the session today. And of course, the one that probably stands out the most to you that are watching right now is Google. Right here in the middle, of course, one of the big captains within the S&P 500 from a market cap perspective, still $1 trillion plus company out there. But it was down 4.5% today, and that was after a horrible day yesterday. It's kind of interesting because I remember having the conversation with you guys just 2 nights ago on Tuesday, and we were talking about how the AI plays were on fire with Microsoft, Nvidia, and Google doing so well. Well, fast forward here just 2 days later, and Google has fallen off of a cliff in a hurry. I want to say that they were priced at like $108 just a couple of days ago, and today they're closer to 95. So that we're talking about significant loss of market cap, like hundreds of billions of dollars types of movements in a very short amount of time. That's quite atypical for a company that size, especially when they didn't report their earnings, right? They already reported their earnings in the past, and so this move here more recently has been more organic, and part of it is apparently they had quite the faux pas on delivering their AI competitor to ChatGPT. Of course, that has a big $10 billion investment from Microsoft, and apparently they were trying to show off what they had accomplished and came back with egg on their face because it didn't work the way that they had anticipated before the presentation. So they're suffering now in the stock market as a result of that, and they're starting to get some momentum out there that maybe, just maybe, Microsoft can actually eat into what has felt like basically a monopoly from Google over the years in search. And of course, that is a very, very lucrative area of our economy. So it's going to be interesting to see those two titans of the tech world, Microsoft and Google, go head to head here in the next couple of years. Anyway, beyond Google, you can see a lot of other red squares out there, including Amazon was down nearly 2% here today. JP Morgan was down 1.5%. Johnson & Johnson was down just over 1%. Microsoft was down over 1%. Apple was down not quite 1%. So those are kind of the bigger movers on the downside from a market cap perspective. On the flip side of the conversation, notice that Tesla was up again, and actually up quite a bit, 3%. I want to say that Tesla is now officially doubled from its lows earlier this year. So think about that for a second. This is a $655 billion company, and it doubled from just over $300 billion company in basically a month and a week. That is how quickly that stock moved. Now, obviously, context is important there because Tesla had an awful 2022, and this rally has probably made up just a slight portion of what it lost last year. Nonetheless, it has been breathtaking, and Tesla feels like it's been up pretty much all the days recently. I think they said on TV that they were up like 8 days in a row. So really impressive move there out of Tesla. NVIDIA, I mentioned before, they were up 0.59% today. So of course they make a lot of semiconductors and other chips that would go into AI and a lot of other areas of our society. We do have United Healthcare up about 0.5%. Salesforce was up 2.38% today. There's been a lot of activist investors kind of circling the wagon, so to speak, at Salesforce. That was another stock that got blitzed last year, but it's coming back to life because all of a sudden it seems like the activist investors are going to start kind of forcing their way into Mark Benioff's world, whether he wants them to or not. I do see that Walmart was up nicely today, almost 1%. Pepsi was up almost 1% today. Some of you saw my tweet earlier this morning that I was quite excited about the dividend increase announcement out of Pepsi. Remember, they're a dividend king, meaning more than 50 years in a row of dividend increases. And they came out with a 10% dividend increase here this morning. That was more than I had anticipated. Usually it's the opposite. Oftentimes what we're finding is that there's a little bit more disappointment out of the older school companies while we've gone through a more difficult economy here lately. But Pepsi, I would put them in the optimistic camp with the 10% increase. I would have expected them to come out with like a 6 or 7% increase, that sort of a thing. So I was quite pleased to see that. Likewise, some of you might have seen my tweet here just about a half an hour ago, before I started recording this video at least, about AbbVie. They were up about 2.83% today. They are a dividend aristocrat, and some of their sales numbers on drugs like Skyrizi and Rinvoq were up quite nicely here today. So that stock had a nice little burst higher. We also saw Activision Blizzard up about 3% today. Of course, that company is speculated to be perhaps bought out by Microsoft, but whether the deal goes through or not is anybody's guess. Remember, I actually can't remember what trade it was. It might have been a bull put spread on that, but it's already expired, and it was, I think, a winning trade for us, if my memory serves me correctly from last month. But anyway, they were up nicely here today as they're reporting earnings and things like that, but there's still a big question mark as to whether Microsoft is going to be able to get that deal done. It sounded like earlier this week we had some negative news on that front from across the pond. Nonetheless, they'll try to work it through the court system one way or another, but that stock was up quite nicely today. Waste Management was up about 1% today as well. That is another company that within the last 24 hours or so raised their dividend quite nicely. I believe that was their 20th year in a row of dividend increases. So not quite into that aristocrat status, but knocking on the door nonetheless. And I would not be surprised at all to find one day Waste Management being a legitimate dividend aristocrat. So anyway, today was one of those risk-off types of days where it seemed like the stocks that were up had specific news stories that surrounded them, and the vast majority of the typical stocks out there were down pretty significantly today. In some cases, high single digits, even in some cases double-digit losses. And we'll actually talk about one of those here a little bit later on in tonight's video with our trade application example. Let's go ahead and take a look at our breadth numbers now. And I'm going to pull up this chart here, which is, or not a chart, but kind of more of a graph, I guess you would call it. But this is the visualize area of the Market Watch tab on Thinkorswim, and you can see that I've pulled up the S&P 500 as my watch list here. This gives us an idea as to what amount of stocks were up versus down on any given day, and that allows us to determine whether it was just the leaders marching in a certain direction or whether the entire army was right there with them. And today was one of those days where it was a down day for the market, and most of the stocks were down. And so that is kind of what you would typically expect. In this case, only 116 stocks managed to close in the green today out of the S&P 500. So that's about a 23% hit rate there. So again, today I would definitely score in the category for the bears. They seem to come alive here once again after the State of the Union address here the other night, where we were hearing some rumblings about corporate taxes going up, and a lot of times the stock market doesn't like to hear that type of commentary. There's a lot more than just that, but I think that kind of added to the cold, wet blanket that was thrown on top of what had been a pretty robust rally up until this point in 2023. Let's go ahead and now jump on over here to the charts. And I had anticipated starting with the daily percentage moves charts today, because about a half an hour before the market closed, we were down over 1% on the S&P 500. In fact, I remember looking over and we were down about 1.11%. But we had a little bit of a rally into the close. So in the final 10, 15 minutes or what have you, we had a little bit of a rally, and therefore we didn't quite close down 1% on the S&P 500. When it was all said and done, we were down 0.88%. So still a bad day, but not quite as bad as it could have been had we closed on the lows of the day. You can see what that candle looks like for the S&P 500, and it was a pretty aggressive looking candle there as well, where we closed near the lows of the day, but not at the exact lows because of that bounce into the close. Also notice that when we're looking at these four different charts here, we've got orange labels in the daily range labels on all four of those charts. And remember, when those labels are orange as opposed to light blue, it tells you that today was an aggressively traded day. It was an above average range day. In other words, the range from the day's high to low was wider than the average true range over the last couple of weeks. And so one way to tell us that, it felt a little bit more chaotic today all of the sudden. Obviously, this is not anything near as disastrous as many of the days that we experienced last year, where we had plenty of days that were down, 2-3% types of days. Nonetheless, because we have been kind of used to seeing the markets gradually climbing the wall of worry so far in 2023, this was just a fresh reminder that risk is out there, and you got to do your best to try to kind of manage through that risk. Some of you that have been following my various trade application examples that I've been showing you in these videos will know that I've done way more bearish trades in 2023 than bullish trades. And up until the last couple of days, that has not really been a rewarding experience, quite frankly. I've felt a little bit behind the curve this year. Late last year, I remember a time where I kind of felt like I was really on top of it with my trades. But this year, I felt a little bit out of sync with it, where my mind has been more bearish, but my eyes are recognizing the bullishness in the charts. And so my mind kind of controlled the trades that I was presenting to you that were the bearish ones earlier this year, but my eyes seeing the markets firming up the way that they have, or the charts firming up, had kind of led me to be less bearish here in the last couple of weeks. But even that, you'll notice that when I got a little bit more bullish, I really just did one of the bullish trades outright, which was Abbott Labs, and unfortunately that was already stopped out. The other ones that were not bearish were not bullish in the opposite. So in other words, if I have a choice to do bearish or bullish, and I say that I'm not going to do a bearish trade, you might be thinking in your head, well, he's doing a bullish trade. Well, you might have noticed what I've been doing here recently, which is way more iron condors than I am used to doing in these presentations. David does a lot more iron condors than I do. So that was how my mind was kind of coming to terms with the situation, where I kind of felt like I was being dragged upwards with this market, even though I didn't really want it to be. And so the way that I kind of rectified that in my own mind is by doing more of the iron condors as opposed to outright bullish trades to the upside. And that's kind of still how my mind is shaping. I look at these charts and I say, yes, there is bullishness here. There is constructive activity, but my mind is still telling me that there's a lot of things wrong with our economy right now. And so, I don't know, maybe some of you are kind of in that mode as well. We'll see how it shakes out, but I want to be able to remain flexible with my thinking. And I think most people who do, trades want to be in that venue. You don't want to be a hardliner on the bullish camp or on the bearish camp. You want to stay flexible with your thinking as time goes along, and each day brings a new piece of information. So all in all, I've been more impressed than I expected to be out of the bullishness of this market so far in 2023, but I can't shake that nasty feeling that it's not going to be this easy to unwind out of the difficulties that we had last year. And so I'm preparing my mind accordingly for that. So anyway, just thought I would share that with you because I'm sure many of you kind of go through those same struggles on a daily basis, like what's the right side of the trade to be, right? And sometimes you kind of have to throw your hands up in the air and say, you know what, if I can't commit to being bearish and I can't either commit to being bullish, then maybe the neutral iron condor trades are going to be a place to kind of hang out while you collect additional evidence to support trades in the future. Anyway, when we're looking at these trades right here, or these charts, I should say, you'll notice that we do have one difference showing up in the charts, and that's in the upper right. The Dow Jones Industrial Average, which was down 0.73% today, you can see now has this pink background color telling us that we have a weekly bearish posture. It's not strongly bearish, but it's weakly bearish because this green line fell out of the upper reversal zone. So it's giving us a heads up that there's been enough wear and tear in the price activity that you should get a little bit more concerned with what you're seeing out of that index. And remember, we have been talking about that for the last few weeks at this point, that the Dow is now our lagging index, because I wanted to make a point of sharing that knowledge with you guys because of the opposite that I was saying at the end of last year. In other words, the Dow was once the leader late in 2022, but earlier this year it passed the baton to these other indices, and now we're seeing more of a confirmation of that visually by seeing the pink show up on the Dow Jones, whereas we don't yet see that on these other charts. We might be heading there as soon as tomorrow, so prepare yourself for that possibility. I say that because you'll notice on the S&P 500, the green line is just barely in the upper reversal zone. It's at 82 right now. Remember, it would just have to fall below 80 to have a pink background color on it. And the same thing with the Russell 2000. Notice that its intermediate line is at 81 right now. And so it could easily go below 80 tomorrow. The NASDAQ's hanging in there a little bit better, but still, if it was a big down day tomorrow, even that one could fall out of the upper reversal zone. It's at 84. So right now, it looks like the NASDAQ is our leader of this market. And I had mentioned that in the video on either Tuesday or last Thursday. I can't remember exactly what day it was when I said what, but I remember having the conversation that the NASDAQ has now taken that baton from the Russell 2000. Remember, earlier in the year in 2023, the Russell 2000 took the baton from the Dow Jones, and it kept that baton for a good 2 or 3 weeks. Here recently, the NASDAQ has come to life and has taken that baton in that relay race from the Russell 2000. So that's kind of where we stand at this moment. So anyway, if we have another sell-off day tomorrow, do not be surprised if when you look at this chart 4B, we start seeing the background colors of both the S&P 500 and the Russell 2000 follow the Dow Jones into that weekly bearish territory right there. As of right now, we're not quite there, so we got to give them the benefit of the doubt. If there's a big update tomorrow, it can resolve that. But, right now, I'm not sure how much I'm going to bank on that, right? A lot of times what you find is that these 30-day moving averages can be acted on as kind of a support area. And right now, we still have air pockets, right? We've got an air pocket right there on the Russell 2000, on the NASDAQ Composite, and on the S&P 500. The Dow is already there. So perhaps we can find some stabilization in that area. Remember, when the markets get choppier, traditionally what you find is that the blue chip companies in the Dow can hold up better than the other areas. They usually lag to the upside, but they lead on a relative basis to the downside. and that is what we experienced today. Notice that the Dow was down 0.73%, which was better than these other three charts. The S&P, as I mentioned before, was down 0.88%, the NASDAQ was down 1.02%, and the Russell 2000 was down 1.4%. So the Dow held up the best today, and if we do have more choppy and more bearish type of trading in front of us, it might have a chance to kind of hold its values a little bit better up here, whereas you've got to be on the lookout for a downward move a little bit more aggressively on these other areas that have an air pocket between where it's trading and its moving average. They became kind of unhinged from where the reality was, right? The moving averages are trying to tell us what's the average price over the last 30 days, and typically you do not see extreme deviations either up or down from those moving averages in normal markets. Right now, I would not call what we went through so far in 2023 a normal market. I've found it to be more bullish than it probably deserved to be, and therefore we are starting to see the flip side of that conversation when the tide turns. So we'll see what happens as we head towards next week, but right now, decent chance that we will see the green line slip out of the upper reversal zone on a couple more of these indices before it's all said and done. One thing I did want to point out is that all of these all of these moving averages are still green, meaning that price is still above a rising moving average in all of these cases. So that is still somewhat bullish, despite what has felt like a little bit more chaotic bearish trading the last couple of days. The other thing that I would point out is that in 3 out of these 4 charts, we have what's known as a bullish intermediate confirmation signal. And that occurs when the green line on the market forecast is considered bullish. And remember, it can be considered bullish in 2 different ways. Either just simply being above 80, regardless of whether it is rising or falling, or if it's between 20 and 80, then it would have to be rising. So for instance, like over here, it was between 20 and 80, but it was falling. So that would not, qualify on a day like that. But over here, it was rising, not yet in the upper reversal zone, but rising. So over here, that could have been a qualifying day. Now, the other piece of that would be that you need the red momentum line to be in the lower reversal zone on that day. With that part of the trade confirmation setup, it cannot just be simply falling between 80 and 20, it has to be in the lower reversal zone. So notice that we have a bullish posture at this moment. Again, it might disappear tomorrow, but as of this moment in time, we've got a bullish posture on the green intermediate line on the S&P 500 because it's still in the upper reversal zone. And at the same time, we have the red line in the lower reversal zone. And in this case, we actually have a pretty legitimate pullback. You guys have heard us talk about that concept that we sometimes use that blue line to help identify what are better setups and what are worse setups. So technically, the blue line is not part of the bullish intermediate confirmation signal, but we like to see it when it's between 20 and 50 because that gives us a sense that there's been a healthier pullback. For those of you that are newer to this presentation and haven't been following David and I over the last 10 years of doing these videos, the idea behind the bullish intermediate confirmation signal is a buy the dip signal. And sometimes you have such a small dip that the blue line is still closer to the upper reversal zone, and it doesn't give you the sense that you're actually getting more bang for your buck. But this one has been a sharper pullback in the last couple of days, and it's forced that blue line down. So this is a little bit more of a legitimate setup here on the S&P 500. With the other 2 down below, so the NASDAQ and the Russell 2000 also have bullish intermediate confirmation signals. But notice in these cases, the blue lines are actually in the lower reversal zone. I know that's hard to see if you're watching this on a small screen, but you can read the labels and you can see the near-term line on the NASDAQ is at 17 and on the Russell 2000 it's at 10. So both of those are below 20. And in those cases, sometimes that is a bad sign because it means that the markets are going to be dragged lower because it's almost too aggressive. So you're kind of, thinking about the Goldilocks scenario where you want it to be aggressive enough to make it seem like you're getting bang for your buck on the buy the dip philosophy, but if it pulls back too much, then it gives you the sense that there is there's more danger lurking behind the corner there. So, you kind of have to do your best to manage through that information. But it is true for those of you that like to look for those signals. We do have bullish intermediate confirmation signals on 3 out of our 4 charts here today. Let's take a quick peek at what's been going on after hours here today as well. Of course, we're still in earnings season, and I wanted to bring up one name in particular. Lyft is getting absolutely smashed after hours. For those of you that live in the United States, you likely recognize that name. For those of you that live outside of the U.S., this is the chief competitor to Uber in the United States. Uber, of course, is a little bit more international, but they're basically ride pickup or ride sharing types of services. And, a couple years ago, they were all the rage, and their services are still used a lot here in the United States. It's just a matter of whether the companies are profitable offering those services. And that has yet to be determined. These companies largely do not make money. They provide a great service for society, and they basically displace the taxi cab industry. But we don't know if it's actually a profitable service yet, right? You could think of these as the innovators and the disruptors. And that sounds great on the surface, but remember, you still owe it to your shareholders to be profitable, and they haven't proven that out yet in their business model. And so Lyft is getting absolutely hammered after hours. They ended the day at $16. Now you can see here the 52-week high has been 45. So we already know that from 45 down to 16, it has not been a pleasant experience if you are a Lyft shareholders. Well, I'm sorry to say it's not going to get any better tomorrow in all likelihood, because as you can see, after they reported their earnings or lack thereof this morning, they actually lost $1.61. The stock is down 30% after hours as we speak, trading closer to $11. And you can see the 52-week low on this one was just a hair below 10, and so it's very close to a 52-week low in the after-hours session and nowhere near the 52-week high. So that's not a great sign for risk appetite as we head into tomorrow morning either. There were a few others that were reporting after the bell tonight. These are not the big players like we went through last week with the Apples and the Microsofts and those kind of market moving types of companies. Nonetheless, sometimes fun to go through them. So let's take a look at what's going on with PayPal after hours. They reported their earnings. They basically are trading after hours exactly where they close the normal session. So not a big reaction there. Net, so this is Cloudflare. This one is actually up pretty nicely. It's trading above $63, even though it closed the day at 58. So that's a pretty healthy percentage increase out of NET, Cloudflare. Another one that I think reported was Yelp. Yeah, Yelp reported as well. And that's actually a pretty nice move out of Yelp percentage-wise, about a 10% move up. They closed the day at around 30. They're trading at about 33 right now. And let's see what else was out there. MODG. Now this is a newer ticker symbol for many of you. You might have known it under its prior ticker symbol of Eli, ELY. This is Topgolf Callaway brands right here. And they changed their ticker symbol to MODG because I think they changed their name to Modern Golf. But for those of you that like Topgolf, I've enjoyed a few rounds of that myself. This is that company behind it. So another kind of growthier type of a name here all of a sudden. And this one is up a little bit after hours, trading here somewhere between 24 and 25 as we speak. It closed the normal session just a little bit below 24. Let's see what else was out there. Expedia reported after the hours tonight. They are down a couple of dollars per share in the after-hours session, but it looks a lot better right now than it did initially. They reported out of the gate, and that stock fell down to 105. They've actually recuperated about 10 of those dollars, and although they're not back to break even, it's going to look like a lot better of a situation than it initially appeared for the Expedia shareholders. Let's take a look at AYX. This is Alteryx. This company looks like they're going to have a pretty impressive move tomorrow morning. They closed the day at 60, and they're trading above 65 as we speak. And then last but not least, let's look at Dexcom as well. and this is ticker symbol DXCM. And you can see here that the market seems to like what they see out of Dexcom. They closed the session at 107 and are trading closer to about 112 right now. And you can see this stock is actually trading closer to its 52-week high than a 52-week low. So kind of the opposite of Lyft there. This is a stock that a lot of people have taken a peek at here in recent years in the medical area and have done reasonably well with diabetes and different things like that. So anyway, that's your recap of this evening's earnings reporters. Not big companies like we experienced last week, nonetheless some bigger movers with Lyft especially in the spotlight as we head into tomorrow morning. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. A reminder that David and I do not get paid to do these videos, and they do take over 3 hours of our day. So if you appreciate the effort that goes into them, as often as we do them, we simply ask you to help support them by clicking like there for us on Twitter. Remember, there's a lot of firms out there like ours that do these free videos, but they have different business models than ours. Others that are similar to us that are on more of a subscription business model, they might do one video a week type of a thing. A lot of them do just a weekend video. But we try to commit more time than that, and we hope that you guys appreciate that. So if you do, again, the easiest way for you to show your appreciation is to click like for us there on Twitter. As I always say, as long as we're up and over 100 likes on the last time I did the video, I'll be more than happy to do another full-length hour-long presentation for you the next time I'm scheduled to do the video. And remember, I do them on Tuesdays and Thursdays. And so on Tuesday, you guys really came through for me with 111 likes. That's quite a bit there in just a 2-day span. So thank you very much for those of you that are helping support us with that. Let's go ahead and do some shout outs here. Thank you to John. Thank you to Angie. Thank you to Joel. Thank you to Jim. Thank you to Robbie and Fathy and Michelle and Judy, Venki, Claire, Abraham, Walter, Prickly Trader. We've got Barry, we've got John and Randy and Jim and Curdy and David and Kevin and Jayesh and Sarah and Ray and Greg and Rich and Scott, Teresa and Irene and George and Roger and Serene and Neil and Nicholas and Ash and Keola. Can't get through all of you. It just soaks up too much time, but I always like to get you mentioned every so often because I know a lot of you commit to doing that for us each and every time we do the video, and we really do appreciate that. It helps get the word out about our company, our very fledgling small company, much better when we have an audience like you that are willing to do that with us as opposed to just David and I trying to get the word out about our organization. So thank you very much. It means a lot to both of us, and please keep that up. All right, let's go ahead and also take a look over here on the Market Scholars website, so that way we can get a sense of what's been going on with the factors out here. Remember, on Tuesday I took you through the conversation of what's been going on with sectors. This is a little bit different. These are different market themes and how they've either been doing well on a relative basis or maybe poorly on a relative basis. So let's see what we can discover here. Low size is leading the way yet again, and remember that's a more speculative area. Now, one thing to be aware of, this is a couple of days old right now, so be aware that it's it could have changed in the last couple of days, and of course I'll instruct folks of any changes next week when I redo the graphic again. We usually review this in my Wednesday morning factor-based swing trading class. So up until this point on Tuesday night's close, low size was still our leader up at that point, but we did have a little bit of a switcheroo in the number 2 and 3 positions there. Notice that quality made its way up to the number 2 position and value fell down to the number 3 position. For those of you that have followed my teachings over time, you might be aware of why that could have happened. Remember that quality these days is controlled in large part by what's happening with technology, which is a little bit strange for a lot of people to hear, but companies like Apple and Microsoft are some of the biggest components within the quality factor. So when technology from a sector perspective is in favor, you will find that quality has a better chance to do well on a relative basis as well. Value these days is still largely a lot of like oil companies and financial stocks, kind of older line companies there. And while financial stocks have done reasonably well, the oil companies have stumbled here in recent weeks. So from my perspective, that kind of explains the switcheroo between those two. A slight improvement in technology companies, a slight detraction there in some of the energy stocks, and that's why quality was able to supplant value in that 2-3 position. Number 4 held the line there with dividend yield, and then we did have a switch at the bottom in the 5-6 position as well, where low volatility got off the mat and then was replaced at the bottom by momentum. And remember, that's a little bit strange as well. Typically, when you have a really bullish market environment, price chasing, which effectively is what momentum is, does well on a relative basis. But this time around, that has not been the case. And from my perspective, the reason is because of how jolting this type of a move has been. It has not been a gradual move. It has been like a light switch type of a move. The exact areas that were in favor just a month and a half ago are the exact areas that are out of favor right now, and vice versa. What was ever out of favor a month and a half ago are exactly the stocks that are up a whole bunch this year. You know, stocks like Carvana that looked like they were on death's door just a couple of months ago have like doubled so far in 2023. So I think that's the reason why we're seeing the lag in momentum, is because the ETFs, the momentum ETFs that make up this graphic, do not have the ability written within their prospectus to change the stripes of their portfolio as much as you might assume that they do. For instance, ticker symbol MTUM, which is one of the momentum ETFs out there, to my knowledge, only updates their portfolio twice a year in November and in May. And so that explains why momentum is partially out of favor right now, because they're still stuck in whatever themes were working in November, even though the market has changed dramatically just from December 31st. So they're kind of still struggling despite what has been a pretty rosy market environment where you would have assumed that momentum was doing better. But this is proof in the pudding. It just simply isn't. So kind of found that to be fascinating as well. Also, remember that we had a busy day at Market Scholars, as we always do for our premium members. I taught for 3.5 straight hours today, which is oftentimes the case on Thursday mornings. So I just sit there and answer questions. Strangely enough, I kind of lose myself in the questions, and I oftentimes don't even know that I've gone that long. But at the 3.5 hour mark, I do have a hard cutoff time there because David needs the platform for his class. So if you're interested in what we talked about in my Q&A class earlier today, that 3.5 hour class is now posted. We had a lot of conversations about bond ladders, about treasury inflation protected securities, about dividend cuts, about a number of other topics out there. So feel free to check that out if that strikes your fancy. And then David taught his portfolio management with ETFs class. And of course, he has some awesome thoughts about his interpretation of what's been going on with the Fed here recently and how that is shaping his mindset about how to manage a portfolio of ETFs that are out there. So make sure you take advantage of those resources if you are a premium member of Market Scholars. And then tomorrow, David will be doing his technical analysis trading room, so that should be a good one as well. All right, let's go ahead and get back on track here with some more Thinkorswim charts. And let's do some 12 grid analysis. So I'm going to pull up the U.S. Actually, let's start with the asset classes. This is the chart 5A 12 grid here. To have that conversation first, and then we'll look at sectors after that. So on this chart, one of the things that I mentioned to you guys on Tuesday that caught my eye was that we all of the sudden have more pink charts than what had been the case in previous weeks, right? In previous weeks, the typical view that we were looking at here during this part of the presentation is that we had oftentimes the lower corners in the red, but everything else was green. Well, look at how things have changed here quite dramatically in just a few days worth of time. Now, all of a sudden, the lower corners, which is the US dollar in the lower left-hand corner and the 10-year Treasury yield in the lower right-hand corner, now have bullish postures, not bearish. And notice how they're both above their moving averages right now as well. So, that is telling us that they're not using the moving averages as resistance areas. These are a little bit more legitimate types of moves where we're holding the levels above the moving average. Notice the US dollar as an example down below here. The last time we went up and touched that moving average, we touched it for just a day and it was immediately rejected and we fell back into that downtrend. This time around, we burst through the moving average and we've really spent the last, let's call it 4 days or so, above that moving average. So it gives you the impression this is a more sustainable bounce attempt that it is going for right now. And whether it holds or not remains to be seen, but so far so good. And remember, when I say so far so good, I'm saying that for those of you that might be long the US dollar, but for the most part, that's a bad thing for the rest of the market. Generally speaking, risk assets do better when the dollar is weak. So this is not necessarily a good thing for the rest of the market, yet it is positive for those of you that are following the US dollar specifically. And kind of the same thing over here with Treasury yields. We were in quite a long period of declining interest rates here, at least on the long end of the curve. We talked about today in my conversation about a lot of T-bills. I actually have my first round of 3-month T-bills maturing here today, and I've been buying them week after week after week, and today is actually the first day that I get those maturities. So my process started exactly 3 months ago, and it will continue for the next 3 months in front of me now. But we were having the conversation in my Q&A class today about how the rates on the 3-month T-bills are so much more attractive than the longer term rates on things like the 10-year. Here you can see the interest rate is closer to about 3.7 or 3.6, but on the 3-month, we're talking about like 100 basis points more than that. Like, I think I still have it pulled up on one of my tabs here, if I can go back and find it. There it is. It's at the 3-month Treasury bill is at 4.75% right now. And again, compare that to the 10-year at 3.68%. I mean, that is just absolutely insane. And that is one of the most extreme inverted yield curves you will ever see in your investing career, is what we are all living with right here, right now. So all of a sudden, it's looking like it's the long end that's trying to catch back up to the short end. Before, we were kind of questioning, something's got to give. You can't have an inverted yield curve like this for years and years on end. Something has to give. And right now, it's kind of looking like it's the long end of the curve that is trying to burst back towards where the short end of the curve is currently. And so, that can change. But right now, this has been a pretty aggressive move in just the last, let's call it 4 or 5 days or so. And so notice that we do have a strongly bullish posture on the yields themselves, which obviously means the opposite for the bonds themselves, right? Bond prices tend to do poorly when interest rates rise and vice versa. And so today, no surprise, TLT took it across the chin. It was down about 0.95% today. And notice that TLT is now trading back below its moving average, whereas the 10-year Treasury yield is back above its own moving average. Remember, those are not identical opposites of one another because technically TLT kind of tracks more of the 20 to 30 year range, but nonetheless, you do oftentimes see that when one of them goes up, the other goes down, and that was the relationship that we saw here today out of those two. So that's wreaking a little bit of havoc, I would say, within the marketplace here, and it seems like the market is taking it a little bit more seriously all of a sudden, whereas it was kind of just a side thought here just a couple of days back. In terms of other charts that are catching my eye, of course, been talking a lot about gold. And gold is starting to become a little bit more concerning. And that is not what I expected, but obviously I'm wrong plenty, right? Nobody's right 100% in this business. So if you're expecting perfection out of me, I'm afraid you're going to be regularly disappointed. But my thought was that gold was starting this epic rally here and would be more likely than not to continue it. I was not surprised to see a give back. Give backs are normal. But this day today was a little bit more concerning out of gold. We'll keep our eye on it, but right now, you don't like to see that type of behavior. Notice if I right-click on this chart and go to maximize the sell, this is a bearish engulfing candle. Not only did it engulf yesterday's candle, but it engulfed the 2 prior days as well. You don't like to see that, especially directly below its moving average. So, obviously things can change because gold is very much pushed around by geopolitical, winds that are out there and news that could impact it. But right now, just from an organic trading perspective, sadly, it's not looking as robust as it was earlier in the year. So I've got to kind of put that in the wait and see category right now. If we can kind of reclaim this moving average, I'll be more than happy to once again consider more bullish trades out of that area. But as of this moment in time, I'm a little bit more standoffish around it again. Remember, I do still have the bull put spread going on Newmont Mining, and we're in good shape on that. I still think that next Friday we will see that roll off of our books at max gain. But I'm a little bit hesitant putting on more gold bullish trades until we see a bit more stabilization in the chart. So I wish I had better news for you on that front, but right now you got to call it like you see it. And right now, it's starting to look a little bit more dicey than I would prefer to see out of gold. So if that changes, I will let you know. But right now, notice the background color has now changed to dark pink as well, telling us that we now have a strongly bearish posture on gold after having what an epic rip this was earlier in the year to get all of these overbought cluster signals. Now you're seeing some extreme price the opposite direction. Oil was down today about 1.11%, but you'll notice that its background color remains light green, telling us that it's still iffy as to whether we're going to go bullish or bearish on this. It's not extreme in either direction, and that makes sense, with this chart basically looking like it's sideways right now. We're well off the highs from 3 months ago, but we're well off the lows from 2.5 months ago as well. So we're still, looking for a little bit more direction. Right now we're below a falling moving average, but the posture remains weakly bullish. So we'll see where that takes us. Bitcoin we've been looking at recently to try to judge risk appetite, and it's done a really good job of holding its early year gains. But today we had a pretty red candle. These have already rolled over, so I can't see what the actual percentage loss was here today. But I do know that when I was with you on Tuesday and we looked at it, its price was above 23,000, and now you can see that the price is down there at 22,800. So it has slipped, a couple $100 at a minimum in just the last couple of days there. And it's starting to look a little bit toppy when you look at that chart pattern right there. Again, you still have, price well above a rising moving average, and you still have a green background, so you want to give it the benefit of the doubt. But, would it be entirely surprising if you saw this give back a lot of those gains here in the future? No, it wouldn't be entirely surprising based upon what we are seeing out of some of those other markets as well. So we'll let you know if there is a major change there. The other bond markets were down today as well. Remember, on Tuesday was a little bit of a goofy day where the junk bonds were actually up that day. Today, you can see they were down worse than these other areas. They were down 0.65%. Part of that was probably because oil was down today. Remember, on Tuesday, oil was up, so that kind of benefited junk bonds on a day like that. But I also think this is risk appetite kind of emerging in the form of more aggressive sell-off in the junk bonds than what you see out of foreign bonds and the U.S. government bonds. Up on the top rung here, you will notice that the foreign stock markets, had kind of mixed results here today. You saw that both of them finished higher, but you'll notice that they both closed near the lows of the day. So it's kind of like good news, bad news type of a thing, where at least we were higher than yesterday's close. But if you bought upon the open today, you were sadly disappointed because you gave up all of those gains as the rest of the day went along. So EFA was up 0.18% today, and then EEM was up 0.47% today. You can see EFA is holding on to its strongly bullish posture, whereas EEM still is stuck with that weekly bearish posture, but it's still sitting there right on that moving average, where if it's going to bounce, this would be the time for it to do that. So we'll keep our eye on that story as well. Preferred stocks we don't talk a lot about because they don't really move the market a whole lot. But remember, we did talk about them a little bit more at the beginning of the year because I was counting out all of those candles, all those days in a row, which was either record breaking or it had to be close to record breaking, because you rarely see any asset class go up that consistently day after day after day. Well, now you can see the opposite starting to creep in. After having these overbought cluster signals, you had a few more days of upside, and then today was a pretty aggressive down day by the looks of that candle there, and you had 3 other sell-off days there. So this one very well could find some support once we get to that rising moving average, but no surprise that after what had been an epic move up and over that moving average, it's starting to give some of that back now. Let's take a look at our sectors. And so this is chart 5C for those of you following along at home. And as you can see, we've got some deterioration here as well from what we were looking at on Tuesday. On Tuesday, we had more green charts. Today, we actually have more pink charts, right? If we count them out, the pink charts are 1, 2, 3, 4, 5, 6, 7. And that means that only 4 of the sectors are in the green charts. So 7 pink, 4 green out of the 11 sectors that are out there. Remember, the 12th chart that you see on the board is the S&P 500 itself. Some of you might be surprised by that, and I always like to remind you from an educational perspective that perhaps you shouldn't be if you know how these things get calculated. And what I mean by that is not every sector has equal influence on the S&P 500. Certain sectors are more important than other sectors, and the most important sector is technology. And the reason for that is where the biggest market caps are, including both Apple and Microsoft. So when technology is doing well, it can offset a couple of the smaller, less important sectors that are out there. So when I say less important, I mean from a market cap perspective. And I'm talking about things like real estate, utilities, materials. Those 3 I would consider less important areas of the market. So the strength in one sector of technology could easily offset the weakness in 3 other minor sectors that are out there. So this is a rare time where you see more sectors down or bearish than bullish, yet the market itself is still retaining its bullish posture because of that market cap weighting, especially the importance of technology and communications. Remember, communications is where you find Facebook/Meta and Alphabet/Google. So anyway, technology is kind of our workhorse in this market at this exact moment in time. You will notice here that energy was able to get its bullish posture back, but I don't know how long that's going to last, quite honestly, because we have a rejection of that falling moving average right now, and I wouldn't be surprised at all to see energy's background color go back to pink as soon as tomorrow if it's down again. So you're one by one seeing these sectors fall off and drop like flies. Earlier, it was kind of just 1 or 2, especially the defensive ones, that were struggling. Speaking of struggling, I should point out utilities got hammered today. Now, you wouldn't know it by necessarily looking at the end result down 1.37%. You're thinking to yourself, that's not that big of a move, is it? It is for utilities. Utilities generally do not move that aggressively, and they were hit hard here today. You can see as I right-click and then maximize the sell, how this candle looks. And with the exception of maybe like that really ugly candle right there, this is one of the uglier candles on the board for this entire 3-month time period that we're looking at here. And of course, what probably catches your eye and what catches my eye, and the reason I'm bringing this up right now, is we have an oversold cluster signal on utilities right now. It's been a while since we've talked about that, right? If we go back, we can see that there are no other sectors that have oversold cluster signals right now. We did have the staples give us an oversold cluster signal here on January 19th, and we did have a very nice reversion to the mean rally immediately after that. Will we get the same thing out of utilities from this point forward? I don't know. A lot of it is driven by interest rates. Remember, utilities are highly interest rate sensitive, and so if interest rates keep on going up, utilities are going to have a hard time benefiting in that environment. On the other hand, if interest rates need to pull back a little bit after a pretty healthy move the last 4 or 5 days, then utilities could very well catch a little bit of a bounce to the upside. So I wanted to point that out because I even noticed that for myself, right? I own a number of utilities personally as a dividend growth investor, and I noticed a lot of them just getting punched in the gut here today. A lot of my stocks are not having the greatest of 2023, unfortunately for me, because a lot of those defensive dividend paying areas are starting to struggle when they really outperformed nicely in 2022. So you got to learn to take the good with the bad in this business. But right now, a lot of my kind of old school types of companies are taking it across the chin. So utilities, you might want to start sniffing around in that area for bounce back candidates, judging by what we see at the sector level here with that oversold cluster signal. In terms of, where we had, good and bad performers on a day-by-day basis here, let's see who the best performer was. It looks like all of our sectors were down today, but from what I can tell here at first blush, it looks like, I take that back. I just saw discretionary in the corner of my eye. Discretionary was only down 0.19%, but remember, that was probably because of Tesla. Tesla was up 3% today, and since it's a market cap weighted system, Tesla has a much bigger impact than the smaller discretionary stocks out there. Anyway, let's go back on over here and do our trade application example now. And speaking of things that have gotten blitzed here to the point of giving you oversold cluster signals recently, like I was just talking about here a moment ago with utilities, I want to show you a stock that, to my recollection, I've never talked about before in my classes or even in these free YouTube videos, which is Baxter International. Now, this company has been around a long time, and on this dividend stair-step chart here, you can see that today it dipped into the blue zone of the dividend stair-step chart, meaning that its current yield is attractive based upon its average high yields over the last decade or so. This chart looks a little bit wonky because of this weird drop-off in the dividend stair-step lines back here in 2015, and I believe that was when they spun off Baxalta. So sometimes when companies do spin-offs or reorganizations, it kind of horses up the charts. But if I were to kind of concentrate just on that time after that, you can see it a little bit better detail that, in that time period, we have not seen Baxter trade into this blue zone. Today was literally the first time in basically the last, let's call it, 6 or 7 years that it has been viewed as what I would consider to be more attractive or perhaps considered more undervalued at that point based upon dividend yield theory. And so today the stock just got smashed. It was down 12% upon apparently a bad earnings reaction, right? The company came in at 88 cents and analysts were expecting 93 cents. So they missed the analysts' expectation and the stock got absolutely whomped here. What I was also going to bring up is that this is a stock that had already been on my radar. You can see here that this one from a weekly chart perspective had a whole bunch of oversold cluster signals showing up at the end of last year and also at the beginning of this year. One interesting thing about this market this year is that I have done relatively few sold put trades in these market outlook videos, and most of you know the reason behind that if you've listened to me for any amount of time. Generally speaking, you can assume that when the market is down 1%, on a Tuesday or a Thursday, there is a high likelihood that you're going to hear my trade application example presented in that video that night be a sold put trade. I really enjoy doing those types of trades. But the thing is, we've had hardly any 1% down days in 2023 that have landed on a Tuesday or a Thursday. We've had a few of them, but they've usually been on Monday, Wednesday, or Friday when I'm not doing the video. So strangely enough, when I went back and looked at where our portfolios were standing right now, I would notice that we only had 2 other sold put trades. One of them was Target, And this one will expire next week. So this is the February contracts. And of course, it looks like we're going to go to max gain on that trade. But that trade was put on back in the end of December, not even in calendar year 2023. And then the only other sold put trade that we had for this market outlook presentation was Tyson. And likewise, we're in good shape on that trade as well. And we put it on back in December. So oddly enough, I've been kind of chomping at the bit to do more sold put trades for you guys in these videos, but I just haven't had the right market conditions because the market has been so darn strong, especially on the days where I'm scheduled to do the video. So today was a rare day where a half an hour before the market closed, the S&P 500 was down over 1%, as I had mentioned before. And, it wasn't until the final, 10, 15 minutes that we closed just barely under 1%. But at the time I placed this sold put trade, the market was down 1%. Remember, I do these trades when the market is open, so that way I can send out the trade details to those of you that are premium members on our Telegram app. And as you can see, when we were over here on the trade tab, I sold the March 35 puts and I was filled at 32 cents here. So that's kind of where we're sitting with this one. To put that into perspective, 35 bucks on the chart is approximately right here. So it would basically have to fall an additional $5 per share in the coming, let's call it month and a half or so. And obviously they've got the big event of earnings out of the way. So my hope is that they don't continue to plunge at this rate. Could they? Of course they could. I don't know the future any more than you guys do. So as I always say, if you plan on taking a trade like this, make sure that you're comfortable buying that stock at the strike price of $35, because if you're not comfortable with that, then the amount of money that you receive up front in the form of the credit is probably not going to be worth your while to do the trade. So each one of you has to make up your mind on that, whether this is the type of company that you would want in your long-term portfolio or not. And while it's not a name that I've ever mentioned before to you guys, it is one that is fresh. In other words, the reason we haven't talked about it in my classes is because since most of you guys have known me over time has been during this time right here where it's been trading up in the orange overvalued zone. This is literally the first time that it's been down here in that blue attractive undervalued zone. The other thing I wanted to show you as to why it was on my radar here recently is if you were to switch the chart from a weekly chart to instead a monthly chart with an aggregation period, notice that it's actually been putting in monthly oversold cluster signals as well, which is quite rare. The longer the aggregation period, the more rare the signals are. And so this one has been plotting these oversold monthly clusters in addition to the weekly clusters. So that was the reasoning behind the trade. If we were to get this one locked down at a $35 cost basis, our yield would be well in excess of 3% on this stock, which rarely does have 3% yields. Okay, so that's what I had for you here today. A rare opportunity for me to show you one of my favorite trades, the sold put trade, yet again. If you appreciated the explanation of why that one caught my eye and for me digging this one up for you, whereas you probably wouldn't have stumbled across it on your own, then I ask one simple request out of you. Click like for me there on Twitter. It only takes you 5 seconds. If we're up and over 100 likes again by the time I'm scheduled to do the video on Tuesday, I'll give you another full-length video like this one was tonight with a trade application example. On the other hand, if you prefer the shorter 15-minute version of the video with no trade application example, then don't click like. If we're under 100 likes, then we'll keep it nice and short for you there on Tuesday. So that's what I had for you here tonight. I hope you enjoyed the presentation. Thank you for checking it out. Best of luck to those of you that are Eagles and Chiefs fans. I'm very much looking forward to the Super Bowl. I think it's going to be a great game, and hopefully lots of exciting commercials will be during the Super Bowl there as well. So enjoy your weekend, whatever it is that you have planned, and I'll look forward to seeing all of you next week. Best of success with your trades and your investments. Goodbye for now.